basically Florida is still crushing rent growth across the board, and then Phoenix is falling the hardest, and then everywhere else is kind of standard. So, but yeah, okay. Well, that being said, we're going to talk about bonus depreciation today. Thanks for coming by, late boomer Philbrik. We wanted to talk about this because, well, this is one of the last years that we can do 100% bonus depreciation. Basically, starting next year, it steps down from 100% bonus depreciation down to 80, then 60, 40, and then by 2027, we'll basically have no more, bonus depreciation. You'll still have like the standard depreciation, but you won't be able to write off the whole property basically in that first year, which is a pretty significant tax write-off. So we wanted to bring Boomer. He's got a presentation for us today, and to talk about basically this quote unquote once in a lifetime tax break. Hopefully there'll be something new, but that's why we wanted to bring him here, and so he could talk to us about how we can implement cost segregation and how to put all the pieces together. So without further ado, thanks again, Boomer, for coming.
Absolutely. Thank you. Okay, so tonight we're going to talk about cost segregation. So a lot of you probably haven't heard about the word cost segregation. All that it is it is accelerated depreciation on your property. So what cost segregation is when you purchase a property, every single line item, every single asset inside your property is going to be depreciated as one single line item over 27.5 years if it's a multifamily property, or over 39 years if it's a commercial property or an Airbnb. So what we do, an engineering firm does, is they're going to break your study down into probably 40 or 50 different components and place those components into 3 different buckets. There's going to be a 5-year bucket, a 15-year bucket, and a 27.5-year bucket. Now, your goal as an investor is to shorten down the life of as many assets as possible. So all that we're going to do is we're going to individualize your building components of the property and place them into their correct shorter class life. So the buckets that you see here, the kind of items that are going to go in the 5-year bucket are going to be things like your flooring, your molding, your kitchen cabinets and countertops, your bathrooms, your window coverings, your light fixtures. If you have a security system, all things like that are going to go into the 5-year bucket. Into the 15-year bucket is going to be things like your parking lot, your landscaping, and any kind of exterior signs, fences, or walls are going to go into the 15-year bucket. Everything else structural in terms of the roof, the foundation, the walls, the HVAC, everything like that's going to stay in 27.5 years. Now, kind of like what Nelson was mentioning is that back in 2017, whenever Trump released the Tax Cuts and Jobs Act, he said any asset that has a class life of less than 20 years, you can take 100% bonus depreciation on and reap it all in year 1. So it doesn't matter what we put in the 5-year bucket or the 15-year bucket. Those are both less than 20 years. So you're going to be able to fully depreciate those assets immediately in year 1. So what is cost segregation? Cost seg allows you to depreciate your property over a faster schedule, which is going to increase your annual depreciation, which will reduce your income, reduce your tax liability, and ultimately increase your cash flow. So one thing that you kind of want to touch on is that if you or your spouse qualifies as a real estate professional, you're going to be able to offset any kind of income that you or your family has. If you guys are both W-2, it's only going to offset your passive income or your rental income. So let's say that we do a study on one of your properties, but you own 4 properties. The accelerated depreciation does not have to stay with that one property. It can go to offset income from all 4 of your properties because all of your rental properties are going to be aggregated together. So those are the kind of 2 differences that you'll see if you qualify as a real estate professional, or if you are a high income W-2 earner, then it's only going to offset your passive income. So like I mentioned, the Tax Cuts and Jobs Act was a total game changer for accelerated depreciation. It introduced 100% bonus depreciation. Like Nelson mentioned, This is good through the end of calendar year 2022. So even next year, when you're filing your taxes, you'll still be able to use 100% bonus depreciation, but the assets just have to be purchased or placed into service before December 31st of this year. Then it's 80%, 60%, etc. So the Biden administration hasn't given us any kind of guidance on if they're going to extend this, if they're going to make any different changes to it, anything like that. So we haven't gotten any new guidance on that, but we'll kind of see as we get closer to the bonus depreciation being phased out. But right now at 100% bonus depreciation, there's no better investment vehicle you can have than real estate. So a lot of people say, well, why didn't my CPA tell me about it? So here's a quote from the American Institute of CPAs. When it comes to real estate acquisitions, the jewel of cost seg is that it yields enhanced depreciation deductions. There can be astounding differences between using it and not using it. So the major advantage is it's not necessarily going to produce more depreciation deductions. Instead, due to the time value of money, everything's going to be front loaded. And then you, the smart business person, you, the smart investor, are going to have more money in your pocket now to either buy another property, fix up a property, pay down debt, whatever you want to do. But it's giving you the cash flow right now. So here is what a depreciation schedule looks like. So as you can see in the top of the page, every single component inside the property is going to be intertwined together and depreciated as one single line item over 27.5 years. So what we do, if you want to call it reverse engineering, we're going to come in and break your property down into probably 40 or 50 different components and place those components into their correct and shorter class life. So everything's not going to stay in 27.5 year. It's going to be broken out and depreciated over its shorter class life. Now, this is key if you are doing any kind of renovations or improvements to your property. So let's give an example here. Let's say that you buy a property and 2 years after you buy the property, you have to replace the roof. Well, whenever you pull off that old roof and throw it in the dumpster, that roof has no value to you. You threw it away, it's gone. What a cost seg study does is it's going to break the roof out into its own individual asset and place an exact dollar value on that roof. So using round numbers here, let's say that the roof has a value of $500,000. You've owned the property for 2 years. So after the 2 years of owning the property, that $500,000 roof still has $450,000 of depreciation in it. Whenever you throw that roof in the dumpster and put on a new roof, you're going to get a one-time $450,000 expense because it was its own individual asset and it was no longer intertwined with the entire building itself, depreciated over 27.5 years. So cost seg is key if you are doing value add to your properties, because it doesn't matter if you buy a 30-year-old property. Anytime there's a new transaction, the depreciation starts over. So even though your property was built in 1990, as soon as you buy the property, the IRS looks at everything as being brand new because you've only owned it for a few weeks or a month or a year. So it's very important to do a cost seg study early on. So whenever you remove certain components of the property and throw it in the dumpster, you're going to be able to expense that versus having to throw it away and have nothing to show for it. So if you do not do a cost seg study, this is what your depreciation schedule is going to look like. Your entire building of the property is going to be depreciated as one single line item, and then land is going to be pulled out because you cannot depreciate land. So this is what a depreciation schedule is going to look like for everyone that is doing straight line depreciation. So here is what one of our studies will look like. So you can see in the top right-hand corner here, the building cost of this property was just under 1.5 million. So over here in the top left-hand corner, you can see the 5-year property, 7-year property, 15-year property, and 27.5-year property. So we were able to accelerate 14.4% of the property into the 5-year bucket, 11.9% of the property into the 15-year bucket, and then the remaining 73% stayed in the 27.5-year bucket. So over here in the third column from the right, it says total depreciation without analysis. So this property here was placed into service in April of 2020. So on a typical year, this property is going to have $54,000 of depreciation, but because they only owned it for 8 months of the year, it is prorated for the number of days of the year they own the property. So that's why instead of 54,000, they have 38,000. Every other year going forward, they're going to have 54,000. By doing the cost seg study, instead of having 38,000, you're going to have an additional $381,000, which is what we accelerated into the 5-year and the 15-year. So you're going to have $419,000 of depreciation expense in year 1 using bonus depreciation. Now, a question that I get a lot is, you know what, Boomer, that sounds great that I can have $420,000 of depreciation in year 1, but what about all the rest of the years that I own the property? We're not taking all the depreciation. We're only taking what the IRS allows. So in this example here, it was 26.3% we were able to accelerate. If you see this middle column here that says total depreciation with analysis, the first year you're going to have 419,000. Every other year going forward, you're going to have 39,900. So we're not taking all of it. We're just taking what the IRS allows, and you're still going to have the remaining amount depreciated every other year of the life of the property. Now, another question I get is, you know what? $420,000 sounds great, but this year I don't have $420,000 of income. What happens to that? The beauty of cost seg is it is not a use it or lose it. You can use it until it is exhausted. So let's say out of that 420,000, you use 100,000 the first year. So you're going to carry forward 319,000 to the next year, and beyond until it's exhausted. So you use it as you need it until it's exhausted. It is not a use it or lose it. So that's the beauty of cost seg. The two things is number one, it works on both new and existing properties. So even if you've owned a property for a couple years, cost seg still works for you. We will simply pull forward all the money you left on the table the past few years, get you caught up. So it looks like you're doing accelerated depreciation from the beginning. And it's not a use it or lose it. You get it as you need it, the full amount. So here's what a cost seg study is going to look like. So let's say you own an apartment complex, and let's say that there are 8 buildings on the property. Every single building has to be studied individually. So here we have the site. So this is going to be everything that is not a building on the property. So out of that roughly $1.5 million purchase price, $214,000 went to the site of the property. So here is how it was broken down. So the security and exterior lighting was a 5-year asset. The parking lot, your exterior signage, the striping, the sidewalks and curbs, your landscaping, your security in the parking lot, your fences, your walls, and your mailboxes are all able to be accelerated. So even nothing that is a building that is making you money, you're going to be able to accelerate here $177,000 right away on that. Because remember, a lot of these assets are 15-year assets, but 15 years is less than 20 years. So you're going to be able to fully depreciate those assets immediately in year 1. Here we go to an apartment building. Like I said, this is one of 7 or 8 on the property. This building itself has a cost basis of $185,000. You can see we were able to accelerate 17.7%. And this is how it was broken down. Your cabinets, your moldings, your window treatments, any kind of specialty electrical or plumbing, your security and appliances are all going to be able to be moved from 27.5 years to 5 years. Kind of a rule of thumb to think about is a place has to be livable. Anything that makes the property more comfortable for someone to live, chances are you're going to be able to accelerate those assets. So if you have any kind of carpeting or flooring, chances are that's going to be able to be accelerated. Any kind of window coverings, any kind of specialty light fixtures, any kind of appliances, any kind of specialty things like that are all going to be able to be accelerated. Everything else, like your roof, your foundation, your HVAC, and things that are required for the building to be livable, those are all going to stay in 27.5 year. So you kind of see here, so we have all the buildings that people live in. Now here you have the office building where your property manager is going to be, and the laundry. So the office building on this property was worth 64,000. We were able to accelerate 23.5%. Here's what we were able to accelerate again. Your cabinets, your security system, the window treatments, the specialty HVAC that goes to the laundry equipment, specialty plumbing, appliances and security, things like that are all going to be able to be accelerated as well. So that's what a property is going to look like. Now, a lot of times people will go, I've heard about cost seg, but I didn't really think that cost seg applied to me. I thought it applied to people that own multi-million-dollar properties. That is a common misconception. So if we would have talked probably 5 or 7 or 10 years ago, yes, you'd have to have a property that was $2 million for cost seg to make sense, because the study fees were very, very high at that point. With the advancements in technology and a lot of sweat equity, these costs of these studies has come down considerably over the years. So now if you have a property that's worth about $175,000 or more, chances are cost seg might make sense for you. It does not matter how many doors you have, single family homes work, a small office building or a vet clinic or a warehouse or things like that all work as well. So just think, if your property, your purchase price plus renovations and improvements, if those are more than $175,000, chances are cost seg might work for you. Like I mentioned before, cost seg works on both new and existing properties. So even if you own a property for a few years, cost seg can still work for you. No, you don't have to amend your previous returns. So if you, let's say you bought a property in 2019 and you want to do a cost seg study for 2021, there is something which is called a Form 3115-3115. That is a change in accounting form. That form tells the IRS, I was doing straight line depreciation, but now I changed my mind and now I'm going to do accelerated depreciation. We complete that form for you to give to your CPA to file with your taxes, but that is all that needs to be done for you to switch from straight line depreciation to accelerated depreciation on a property that you've owned for a few years. Another question, I don't want to trigger an audit. The accelerated method is the IRS's preferred method. The thing is that an engineer has to do the study. So unless you use one of the big 4 accounting firms, chances are they don't have an engineer in-house to do the study. So it has to be outsourced to an engineering firm like ourselves to be able to complete the study and be able to back up all of the calculations. So we've done over 20,000 studies in all 50 states, never once triggered an audit. If you're audited for some other reason, we defend our work 100%. These studies are completely bulletproof to you. If the IRS has any questions, they don't come to you, they come to us. Normally it's a very quick question, a very quick conversation, and you're good to go. We've never had a single line item overturned. So these things are completely bulletproof to you. So that is touching on cost segregation. So here is another thing that is very, very important for people that own multifamily properties. So it's called the tangible property regulations. So these were introduced in 2014, where I mentioned before, where cost segregation is not a use it or lose it, the tangible property regulations are. So every single year that you do any renovations on your building, this affects you. So as I mentioned before, after a cost seg study has been performed, we're going to break out your assets into their individual class lives and place an exact dollar value on each individual asset down to the penny. After that, the asset's going to be viewed as its own individual asset. It's no longer going to be intertwined with the building itself. So as in this example here that I mentioned before, if you throw an asset away that a cost seg study has already been performed on, you're going to be able to expense the remaining amount. Had you not done the cost seg study, you would not be able to take any loss because it would still be intertwined in the building. The key to remember here, anytime you're doing renovations and improvements, is this is a use it or lose it. It has to be done in the same year that the work was done. Otherwise, unfortunately, it is gone forever. So you might be thinking, okay, this sounds great. I would like to learn a little bit more about it and see how it directly applies to me. So it is very easy to get a cost seg analysis. Every person on this call has a separate situation and a separate individual that we want to look at separately. So what we're going to do is we're going to run an analysis on your property. We're going to find out more about your own tax situation and figure out, does cost seg make sense for me now? Or might it make sense in a couple years whenever my income's higher or my portfolio is bigger or something like that? We're happy to look at any kind of properties that you have. So a way to get a cost seg analysis done is I'm simply going to ask you 4 questions. When was the property purchased? What was the purchase price? Have you done any renovations or improvements? And if so, how much did you spend? And what is the address? So with that, I can give it to the engineers. They can take a look at the property and put together a no-cost analysis for you, which is going to paint a very clear picture of what your savings is going to look like. So that's what we want to do. So this might sound like it was coming out of a fire hose tonight, and it might be very fast for you. But after we have an individual conversation and we put together an analysis for you on your properties, and you have something tangible in front of you that directly applies to you, this picture is going to become very clear. So please, if you think this might apply to you, don't hesitate to reach out. And I'm happy to talk about any properties that you have, any situations that you have, or anything that you think might be a tax savings or a tax advantage for you. So one thing to remember is that chances are your CPA is doing a great job filing your taxes, keeping you out of audit, keeping you in compliance. It is not their job to seek out additional tax savings opportunities for you. So this is why you coming to different educational forums, educational platforms, reading books, listening to podcasts, going to conferences. This is how you are separating yourself from everybody else, because the tax laws are designed for everybody. So the same laws that apply to Apple, Google, and Delta Airlines apply to you and me as well. So people simply don't realize that. But the tax laws are very, very building owner friendly right now. So if you think this might apply to you, please reach out. We'll look at your individual situation and we will find out if there are any tax savings opportunities for you right now that you were not aware of that might help your situation. So on there, you have my contact information, my cell phone, email. Don't hesitate to reach out, call me, text me, email me, and I'm happy to have individual conversations with you about your own situations. So I appreciate your time tonight and happy to answer any questions that you might have regarding this or any other situations.
All right, thank you, Boomer. All right, we got a list of questions. I'm going to start going from the top. Quick heads up, Annie has mentioned that we are now doing SARE dating applications. So if you want to get matched with somebody who is single with reps, this is the opportunity. Reach out to Annie about that. Okay, Sunny asks, what if you're a part-time W-2 and also part-time real estate agent? Can you still qualify?
So that's going to be something that is very close. So the way the IRS looks at it is that you have to spend roughly 750 hours on real estate related activities for you to qualify as a real estate professional. In this example here that was provided, if you spend half your time W-2, half your time real estate, the question that the IRS is going to ask is that, are you making similar amounts of income in those two roles? Because let's say, for example, you're making $300,000 in your W-2 and in your real estate, you're making $50,000. They're going to go, why would you spend equal amounts of time if you're making 6 times as much money in your W-2? So as long as you have similar amounts of income and you're meeting that 750 hours, 750 hours is really not that much. It comes out to 15 hours a week. So chances are a lot of you are already hitting that. It's just making sure that you're going to meet their stipulation of being able to have similar amounts of income for that. So the IRS knows that this is very low-hanging fruit because it's a total game changer if you can offset your entire family's income by using real estate. But so yes, there's a lot of ways to qualify, but if you're a W-2, your income has to be on a similar level.
Awesome. And don't forget, you have to spend more time on the real estate than the actual W-2 as well. Danny asked, at what price point should we not do a cost seg? I know you said if you have more than 200,000 of cost basis, you should consider it, but at what point should we not do it price point wise for cost
So
seg?
basically, there's going to be only two reasons why you wouldn't do a cost seg study. Number one, if you don't make any money, because cost seg is used to reduce your income, to increase your cash flow. And number two, if you are buying and selling properties in the same year. So if you're doing fix and flip and selling those, cost seg is not going to apply to you because you're going to have recapture on the properties because you didn't hold the property for long enough. So those are the two main reasons not to do it. But everything is relative in terms to the amount of savings that you're going to have. So like, for example, I have a dog and I did a cost seg study on our vet's office, and our vet saved like $4,000 and he thought I was a hero. So everything is relative to everybody. So some savings will be in high 6 and 7 figures, depending on the cost of the property. But other times it's how much can affect your personal situation. So I always look at it from an ROI perspective, because I always want to put myself in your shoes and be like, would I recommend this? Is this a good decision for me? So if the ROI perspective makes sense in terms of what your savings is going to look like versus what the study fees are, if you're looking at about 175 to 200 grand or more, chances are the ROI is going to make sense. We're just going to have to look at your different income level to figure out, do you need the increase in depreciation to offset your income, or is the income level not there? So those are the kind of the main things. But yes, if you have, call it 175 or $200,000 or more, it's worth us having a conversation.
Most people have less than 4 units. So could you give us an estimate of what you think the cost for the study fees might be for something like that?
So something like that, you're probably looking at about $2,000 for something like that. And like if you have a duplex, let's say, and let's say the duplex costs $300,000, your savings on that's probably going to look like probably 60 or 70 grand. So if you can have that kind of savings and it costs you $2,000, that's going to make a whole lot of sense. So yeah, so in those situations, yes, chances are it's probably going to make sense.
Got it. Roger asked, he bought a triplex in 2021, then remodeled. Can he cost seg the old assets, then cost seg bonus depreciate the new assets that he remodeled in? If he has pictures of both before and after the remodel, how does it work?
The whole thing there is that if he is still on extension for 2021, can that be done? Yes. Otherwise, you're only going to be able to study the building plus the renovations. You're not going to be able to realize what was thrown away because it was done in a previous year. So if he's already filed taxes for 21 and we're looking at tax year 2022, then we're just going to go purchase price plus renovations. Otherwise, if we're still doing it for 21, yes, you can look at the assets that were in the building that when he bought it that he got rid of.
And then he had a building in 2017 that he wants to bonus depreciate. But of course, like you said earlier, there's a form that you sign up for that says, hey, I'm no longer doing regular. I'm going towards, bonus depreciation instead, accelerated depreciation.
Correct. Yeah, that it's called a form 3115-3115. So yes, we complete that form for you to give to your CPA, but that has to be filed with your taxes. And that tells the IRS, I was doing straight line, but now I changed my mind and I'm going to do accelerated.
Yep. Josephine asks, can this be done on primary homes or only on investment properties? It's investment property only, except if you house hack. I had this experience. I lived in a quadplex. I lived in 1 unit. I was told I bonus depreciated the other 3 that I didn't live in. Is that right, Boomer?
That's correct. So your primary residence, it has to be a revenue income producing property. But yes, if you live in 1 unit of your house and the other 75% is rented out, then you can depreciate and cost seg the other 75%.
Got it. Vivian asked, for the purposes of bookkeeping, is there a list of categories you should keep for the cost segregation exercise?
So whenever we do a cost seg study, we will break down the different assets of the property and place them into their class lives. This is something that as you do 1 study, 2 studies, 3 studies, it becomes very clear. So one thing that I don't want to be is I don't want to simply be a cost seg vendor where I do a cost seg study for you, we shake hands and go our separate ways. I more want to be a partner for you within your tax team to help you save money over the life of the property. So simply reach out to me, call me, email me, whatever. I'm happy to help you kind of guide your and plan for your renovations to figure out when you want to do them, how you want to structure them, how your invoices need to be structured so that you'll be able to take advantage of them. Because a lot of times you're going to be able to expense what you're doing. And cost seg is great, but anything that you can expense is even better. So anything that we can do to help you save money and help you expense things, we're happy to do. So yeah, simply just reach out and you'll kind of get the hang of it as you do 1 or 2 studies. But until that point, happy to help out in any way.
Josephine asks, what happens if we sell the property before 27.5 years?
Okay, so kind of what I mentioned where cost seg does not make sense for people who fix and flip properties. Let's say that you buy a property in 2019, you do a cost seg study, and you go and sell it in 2022. So you own the property for 3 years. But you did 100% bonus depreciation and you realized everything in the 5-year bucket, everything in the 15-year bucket. So most of the assets are going to go into the 5-year bucket. You will have realized 3/5 or 60% of that whenever you did the cost seg study. So in theory, there's going to be recapture on the remaining amount of that 5 years that you did not realize as ownership. However, the kind of assets that are going to go in the 5-year bucket are going to be things like your flooring. So like, let's say that you have carpeting in your property. Everyone knows that carpeting is not going to last 5 years. So we're going to place a dollar value on the flooring, the carpeting in the property. Let's say that we placed a dollar value on it of $2,000. Well, whenever you go to sell your property, yes, you're selling your property, but in theory, you're selling individual assets. So your CPA is going to look at the carpeting and be like, okay, this carpeting is 3 years old. It initially had a $2,000 value. This carpeting's worth, call it $400 right now. So your recapture would be that $400. So if you're going to hold a property for 2 or 3 years, chances are cost seg is going to make sense for you. So yes, there might be recapture on it, but if you are doing a 1031 or you're going to get into a different kind of property, all you do is you cost seg your new property and you're not going to have any kind of recapture because it'll wipe out all of your recapture and you'll still have additional depreciation from the new property. So it's kind of in theory, as long as you keep on buying, the party never stops. But yeah, if you're going to hold a property for 3 years or more, chances are cost seg is going to make sense for you.
Got it. Adam said, if I don't qualify for rep status this year, but may qualify next year, should I wait until next year to do a cost segregation analysis?
So that's a good question. So the whole thing is that I like to look at your individual situations because if you have a tax liability this year, it makes sense for you not to pay that tax liability. So if we can offset that tax liability, great. If not, and you're going to be able to offset all of your family's income for next year, yes, it might make sense to hold off, but let's look at your individual situation and let's figure out what's going to make the most sense for you. But being a real estate professional is a total game changer. And I'm sure that's a lot of people's goals whenever they're starting to get into real estate, because that's when you're going to see the real benefit of it, being able to offset any kind of income that you have in your life.
It's a depreciation carry forward, right? Or sorry, the tax write-off you carry forward, I thought.
Correct. Yes. Yeah. But the whole thing is that if you start off and you are not a real estate professional and you go to carry it forward, it's not going to be able to switch to being active income next year.
I see.
So so that's why in his situation, chances are it might make sense for him to hold off till he's a real estate professional. But anything with that property would still stay passive.
Got it. Got it. Okay. Johnson asked if you already had a property that we answered this already. Basically, if you're straight line depreciated and then you want to switch and do cost seg acceleration depreciated, it's just a form that they can fill out, give it to your CPA, and that'll tell the government you're switching over from straight line to accelerated depreciation.
Correct.
Asked, I have a property that I'm still renovating, purchased at the beginning of this year, plan to finish up the renovation and rent it out. This is not my primary home. Can I cost seg this property? Yes. Let's see. Jonathan Tao asked, how long does,
Sorry, I had a question for that. So if there's no rental income for Cindy's situation, are you guys still able to do a cost seg study even though there's no rental previous history at all from a rental income perspective?
So you're saying that the property was a rental property and then she moved into the property, so now it's just the primary residence?
No, I'm saying that I have a property exactly like Cindy where I bought it this year. Rent is currently being renovated right now and it's completely vacant. So then when you guys do the cost seg study, are you guys just gonna use market rent to like help us figure out how much you guys can help us save from a cost seg study purposes?
So chances are the property's being renovated right now, so it is not livable.
Yeah, it's completely vacant and it doesn't have an occupational like certification yet.
Yeah. So then the building would not be placed into service yet. So even though you bought it previously, until the property is livable, the property is not going to be placed into service. So chances are this property will be placed into service later this year or the beginning of next year. And that's when the property will be placed into service. So that's when a cost seg study could be performed.
But in her
Oh,
situation, if it's 2023, then doesn't that mean she loses that on the 100%
Yeah.
depreciation?
It just becomes 80% then. So, which is still good because before the Tax Cuts and Jobs Act, it was 50%, and you still get the full amount, just not in year one. So
Right.
you get it in the first 5 or 6 years. So 80% is still going to be good. It's just not all right away. So,
yeah,
but for in your example, if the property is livable by December 31st, and even though you don't have a tenant in there yet, but it is livable, the property can be considered placed into service.
Gotcha. Okay.
You might want to consider that. As long as there's like running water and power, yes, the property can be placed into service.
Gotcha. So yeah, it will be rented and I mean, it will be livable and be ready by the end of September. So I
Okay.
just wanted to make sure that as long as there's some type of income, but now it looks like it's livable. That's the
Yep.
only way. I thought it had to have income, but okay, that sounds good. Thank you.
No, as long as the property is livable and you're planning on renting it, yes, you can do a cost seg study on it.
Perfect. Thank you so much.
oh, and what he was mentioning earlier was like, you get 80% the first year, but if you do after that straight line, it's 3.5% every year. So, you're gonna still make the rest of it at some point. It's just not the full amount in year one. So Vivian asks, is the multifamily tangible property regulation for duplexes 2, or is it for apartment complexes only 5+ units?
No, it works for everything. So even if you have a single family house, I do quite a few vacation rentals, Airbnb type thing. So it does not matter the number of doors. It's simply going to go off of what your cost basis is. So it's going to work for all of it.
Gotcha. And how much will it cost to do a cost seg for a $450,000 single family home? Okay, you mentioned earlier it's part 2,000, right?
Yeah, it's going to be around there. So it's all going to come down to engineering time. But yeah, you're probably looking at about around $2,000.
Okay, Roger mentioned you can offset 25,000 of earned income from cost seg bonus depreciation if you earn less than $150,000 from W2. Yes, that's correct. It's actually, you can offset 25,000 up until 100,000 in income, and then it starts phasing out until you hit 150,000 of income from a year, and then after that you can't write off anymore. Johnson asks, I heard a cost seg could be conducted to offset your W2 if you materially participate and self-manage in your short-term rental, even if you aren't a real estate professional. Could you comment on that?
Yeah, so there is like the exception there. So yes, if short-term rental is going to be considered if you have a tenant less than 30 days. So yes, for an Airbnb and things like that, yes, that applies.
Got it. Vivian asks, let's say I make $500,000 from a flip and now it's almost the end of the year and I'm still working on the flip. The market has changed and maybe I won't get the value I think it will out of it. Would it be beneficial for me to keep the project I am currently remodeling, turn it into a furnished rental and put it into service this year, or keep it for a year, take the depreciation and sell it the following year?
Can you repeat that question?
So Vivian has almost $500,000 from a flip. It's almost end of the year and she's working on another flip. But so, okay, she has 500,000 of profit and from a flip. She has another flip coming up. The market has changed and she doesn't know if she'll be able to get the value out of it. Would she be able to keep the project that she's remodeling and then turn it into a rental for service instead? Would that be able to offset her possible losses?
Yes.
But when if she takes depreciation and sells it the following year, then she has to repay back the capital gains she would have made.
Then there would be recapture, correct?
Yeah. Or sorry, not capital gains.
31, right?
Well, she flipped it. So like, actually, yeah, if she 1031, it wouldn't be an issue if she did depreciation this year and then 1031 afterwards, right?
Or does it even make sense to do the cost seg if, say, she does it now, use it for that 1 year, and then do the 1031 because it's so close in time? Like,
So if you're going to do a 1031, any kind of recapture you would have is going to be wiped out by your new property. So yes, that would make sense. The whole thing is we want to find ways to alleviate having to pay taxes right now to give you more cash flow. So anything we can do to make that happen. If she's going to do a 1031, she's not going to have to worry about recapture because it's going to be wiped out. So in that situation, it would make sense. We just need to focus on eliminating that 500,000 of capital gain she has.
Got it. So can you do cost seg for a portfolio of single family homes? Will it be more cost efficient if they have a package of homes?
So each physical home that has its own individual address has to be studied separately. So a lot of times I'll have clients that'll have, let's call it, they have 10 homes that are $80,000 a piece. Because they each have to be studied separately, unfortunately, that's not going to make sense because the cost basis is too low. But if their homes are, call it 150, 175 grand or more, then chances are they can make sense. Let me give you a different example. If you have those 10 homes and they are all identical, that is a different situation because then we can study them and use statistical analysis on the other homes. So if they are identical, it could make sense. But if they are homes in a neighborhood that have different floor plans and layouts and things like that, and it's under the, call it 150 grand, chances are it's probably not going to make sense because each property has to be studied individually.
Does it make sense to do cost seg on properties purchased via 1031 exchange?
Oh, absolutely. The whole thing is that whenever you do a 1031, your property is going to have a cost basis. It's not going to be exactly what your purchase price is. It's going to be a different cost basis. So you will find out from your CPA what that cost basis is. And then, yes, if it's 175 grand or more, then yes, it would make sense.
Got it. What should you ask an engineer that offers these services? How do you vet them?
The whole thing is that number one, you want to, it has to be an engineering based study. So with the cost of study fees coming down considerably over the years, a lot of mom and pop cost seg firms have popped up. So you simply want to make sure that the firm's going to be around in the case of an audit down the line. Like I said, we've done over 20,000, never had a single item overturned. So in the event that you're audited, we will be there to defend our work and back you up. You just need to make sure that the firm's reputable and going to be around to do it. So a lot of times on these smaller properties, they'll find a cost seg firm that won't be an engineering based study. It'll be a do it yourself or it'll be something else. You need to have an engineering based study so everything is backed up, especially with all these new IRS agents coming in. They're going to be looking at things like this. So just make sure that it is an engineering based study.
Got it. Does the tax law apply to properties outside of the 50 states, like the US territories, such as Puerto Rico, which if this is federal law, I assume it should?
Yes, as long as you are paying taxes here in the US, yes, those properties count.
Okay, Brian said, I'm partnered on a property 75-25, but my partner is using the property as a primary residence. Can I cost seg 75% of the property that they own?
Is the partner paying you rent?
Brian?
So if the partner is paying you rent, then it is a revenue producing property. So then yes, you can cost seg that. Obviously, with your partner being a 25% owner, he's not going to be able to depreciate his primary residence, but you and him paying you rent, yes, you can depreciate the property. So, and even if there's one partner or there's 40 partners part of a syndication, there is one cost seg study done per property. And then whatever portion of your partnership agreement that it says you get, that's what amount of the depreciation you get.
Got it. Yeah, you should have your K1 that you get in the year for your partnership. And then from there, you'll know how much of the percentage of the depreciation you should take. Okay, Annie asks, where does TPTM have engineering teams available? Which areas do you serve? How long does it take to complete the cost seg studies?
So we've done studies in all 50 states. So we physically have to come out to the properties to take pictures to back up all of our calculations. So myself or someone else will come out to the property to gather the pictures and the data for the engineers. And the process takes, call it, after the pictures are back to the engineers, it probably takes about 2 to 3 weeks to complete. And we do not back up to the calendar year deadline. So we can do a cost seg study even now for tax year 2021. As long as we have it to your CPA by the time that they file your taxes, that works.
Does this apply to triple net industrial and commercial properties? Yes.
Yes.
Vivian said she's a bit confused. If you do 100% bonus depreciation, you still have to do a recapture if you sell the asset a year or two later.
Yes. Yeah, because the whole thing is that you are not realizing the full amount of the depreciation. So we placed your carpeting into the 5-year bucket, but you only own the property for 1 or 2 years. You reaped the full benefit of fully depreciating that asset and that carpet, but you didn't own it for the full amount of time. So yes, you'd be responsible for the recapture on the amount that you accelerated but didn't fully own for the amount of time.
Okay. So looking at Facebook questions now, since we've blasted through all the Zoom ones. Okay, from the top, let's see here. Okay, one question. Can a W-2 employee qualify for bonus appreciation if they have a short-term rental? Andrew, yeah, someone answered this already. Yes, you can, as long as you spend 500 hours on the short-term rental in order to qualify for the bonus appreciation, right?
Yes.
All right. Is 1031 the only way to avoid a recapture?
So the whole thing is you shouldn't really get caught up on the whole recapture portion, because if you're holding a property for 3 years or more, chances are the cost seg is going to make sense for you. And the recapture is going to be such a minimal amount versus what you realize initially. So don't get caught up in that. We will look at your individual situation and your plan whenever we're looking at your analysis of your property and figuring out what's going to make sense. But yeah, this allows you to be very fluid in a situation. So if you get an offer you can't refuse, by all means, you can sell the property. But the recapture is going to be very, very minimal to what your savings was initially, as long as you own the property for a few years.
Good. And then can you use opportunity zones to avoid the next? You can, if you do opportunity zones, to avoid capital gains, but not the depreciation recapture portion. That's why 1031s are better. Otherwise you have to repay the taxes that you wrote off originally. And he said, does the leftover depreciation pass to other passive income, like if she has multiple properties?
Yes, the depreciation from one property doesn't have to stay with that own property. It can go to offset income from other properties that you have in your portfolio. So they're all going to be aggregated together. So yes, that works.
But if, just a follow-up, if you have a partnership, can it go to your other sole proprietor properties, or can it only go through the partnership, multiple properties?
So you're saying that you have a property with a partner, you do a cost seg study on it, you guys each get 50%,
Yeah, and so like if there's leftover, can I use it for my other properties that I don't own with that partner from, or can it only go with the partnerships?
No, no, no,
property
no,
portfolio?
No, that's a good question. So let's say that you get $100,000 of extra depreciation. You and your partner each get 50,000. You can do with that 50,000 whatever you want. That can go to offset other properties that you own with other partners or you own by yourself. That is your 50,000 to use how you see fit.
Gotcha. Okay, perfect. Thank you.
And then, yeah, one final note, always, yes, there are CPAs and mom and pops who can do cost segs. Annie has a story about how her old CPA did a cost seg and then messed up in a way her taxes. So
No, it wasn't that. Like, actually, all I wanted to give you as a warning for everyone that's not working with a CPA or just someone's filing your taxes to double check your properties because, so I can tell you as a testimonial, Boomer did do 4 of the cost eggs for me for 4 multifamilies that I own over in Texas, and he actually had caught my old CPA was well, no, it was an old accountant that was filing my taxes incorrectly for many years. Had put they didn't split the property with the land and just lumped it all as one purchase price. So Boomer actually had to work with my CPA to get all that fixed up. But don't worry, it wasn't Tony. It was an old dude. And then he and my CPA, Tony, the CPA dude, they had to go work together and get my taxes corrected. So yes.
either
Thank
way,
you.
we're coming to a wrap. It's almost a full hour. Thank you again for your time, Boomer. I know this is this is a bit of your evening that we're taking at this moment. I think with that, we're going to wrap up. Unless anyone has any other questions, we're going to call it a night. Thanks, everyone.
Thank you.
Thank you, everyone. Bye bye.